Today in this video I am analyzing companies which are into software development, cloud computing, business process outsourcing BPO, financial services and anything related with the software. The companies that I am analyzing are NIIT Technology, Quess Corp, CYIENT and ECLERX or ECLERX. The data for Quess and CYIENT are up to date till 2019 and NIIT as well as ECLERX, their data is up to date till 12 trailing months. That is, some of these ratios would be utilizing 2018 values and others would be utilizing the 12 trailing months value. So let us start the analysis using graphs. The current market price for these companies range from 1,200 to 4,400 rupees. NIIT Technology is down by 11% from its 52 weeks high. Quess Corp is down by 61%. CYIENT is down by 43%. ECLERX is down by 55%. So here we want the fall to be the least. The script which has fallen the lowest will be considered good and the one which has fallen the most will be considered as having some kind of problem, because of which it has seen a fall in its price from where it was 1 year back. This also creates an opportunity to buy into the company provided all ratios are intact. Next, let us look at the earnings yield of these companies. That is, on the price, what is the earnings that the companies have shown. NIIT Technology's price was 1,274, whereas its earnings for that particular share was 65 rupees in the last year. That works out to an yield of 5.2%. Quess Corp's price was 449 and earnings per share was 17.5 rupees. That works out to an yield of 3.9%. CYIENT price was 471 whereas earnings was 43 rupees per share. That's a high yield of 9.2%. ECLERX price was 585 and earnings was 60 rupees per share. That is an yield of 10.3%. Here we want the highest yield, that is lowest price and highest earnings per share will give you the highest earnings yield. Next we'll look at the price to earnings ratio of the recent 12 trailing months. This is the opposite of earnings yield. In earnings yield we divide earnings per share with price and multiply it by 100. Here in price to earnings we divide the price by the earnings per share and try to understand how far away the price is compared to the earnings of the company. NIIT Technology's current market price was 1,274 but its earnings were just 65 rupees. That is, investors were willing to pay 19.2 times higher than this earnings to buy one share of NIIT Technology. So this gives us an idea as to how expensive the price of the share is compared to its earnings. Quess Corp's price was quoting 25.7 times higher than its earnings of 17.5 rupees per share. CYIENT's price was quoting 10.6 times higher and ECLERX price was quoting 9.5 times higher. So the lower the multiple the better it is, because we are just paying for ECLERX just 9.5 times its earnings of 60 rupees, which is a good multiple. Here my benchmark is that I should be buying shares of a company for less than 25 times its earnings. Investors would change their price earnings ratio according to their risk appetite. Next, let us look at where the price earning was compared to its 5 years average as well as 3 years price earning average. So this will help us understand how or where the price was in the last 5 years compared to the earnings and where it was in the last 3 years compared to the earnings. These are the average values of the 5 years and average values of the last 3 years. The green represents the current price earning, and orange represents the 5 years and blue represents the last 3 years average price earning. NIIT Technology's current price earning of 19.2 times is higher than its both 5 and 3 years average price earning. So it is expensive. Investors are willing to pay higher than their 5 and 3 years average price earning. Quess Corp's current price earning of 25.7 times is lower than its average of both 5 and 3 years, where it was trading at 51 times. So this needs to be looked into, why it was trading at such an high extreme valuations. Even this 25.7 times is very high, so we need to wait for it to come down below 25 at least. CYIENT's current price earning is below its both 5 and 3 years averages. So again, this is a good point to think about entering into this company. ECLERX or ECLERX, I will use the word ECLERX and here I'll use the word CYIENT. ECLERX current price earning is lower than both 5 and 3 years. In fact, current price earning has fallen almost 50% of its 3 years average. So we want to buy when the current price earning is below 25 times and also when it is trading below its 5 and 3 years average. That way we will get to enter into this company at a reasonable valuations. Current market price to the operating cash flow. Operating cash flow is basically calculated by considering all cash inflows and cash outflows only occurring in or during the business activity or operations of the business. So here this is different from the profit value or the earnings that we saw earlier. In the earnings or profit, we consider all incomes and all expenses, whether for that income and expense we have received cash or not received. Whereas for operating cash flow, we consider only cash inflows and outflows occurring out of operating activities of the business. So this shows a true value of what the company has received in terms of cash. Here too, we don't want the values to exceed more than 25 times. That is, as investors, we don't want to pay 25 times more than the operating cash flow that the company generates per share. NIIT's price was quoting 20.6 times higher than its cash earnings per share. Quess was expensive at 32.6 times. CYIENT was available at a reasonable 14 times its cash earnings, and ECLERX price was quoting 7.1 times its cash. So again, here too, ECLERX is better in terms of cash earnings, available at the lowest multiple to cash. Now let us look at the price to free cash flow. The free cash flow is calculated by removing out investments in buying of fixed assets from the operating cash flow. So whatever cash the company has received through operating activities, from that we remove out any investments done in buying of fixed assets. and whatever left after that is the free cash flow. So even when we compare price with the free cash flow per share, here too we don't want to pay more than 25 times. NIIT and Quess Corp both were quoting about 25 times its free cash flow, which is expensive. CYIENT was trading at 22 times its free cash flow, which is slightly below our benchmark. ECLERX was trading at the lowest multiple of 8.2 times its free cash flow. This shows that the price has fallen considerably, that it has come very near to free cash flow per share. Next, we'll compare the price with the book value. The book value is the value that the company has quoted for its shares. This is the value as per the company that the shares are worth. Whereas the market price is the price which investors give to the shares. Either they quote the share at premium to the book value or at discount to the book value. Here we don't want to pay more than 2.5 times of what the company is saying its shares are worth. That is the book value. So NIIT Technologies price to book was high at 3.8 times. That is, investors have given it a high premium and are willing to buy it 3.8 times more than what its actual shares value is as per the company. Quess Corp is very near to the benchmark of 2.5 times. CYIENT is trading at 2.2 times its book value, and the lowest valuation again here is for ECLERX at 1.6 times its book value. So here it creates an opportunity. Now we also need to understand whether other ratios, profitability ratios, growth ratios, cash flow ratios, are those intact? Are those within our comfort zone, and are those not, or basically if they are justified, if all other ratios are proper, then we can think of buying ECLERX services also, because at least price wise or valuation wise it seems very reasonable. Next, we'll look at the price to sales. Here we are trying to understand against the sales that the company has done in the latest year, where was its market cap. That would show us that whether the company's sales are near its market cap or away from its market cap. So when the ratio is as near to 1 as possible, that shows that we are paying a very reasonable value for the shares. NIIT Technologies price was quoting, or market cap basically, was 2.1 times higher than the sales it did in the latest year, that is 2018 in this case. Quess Corp's entire market cap has fallen below what it generated through sales. So here this creates a good opportunity to buy into the company. Again, all ratios have to be considered against different ratios, and we have to consider not just one but many ratios to understand whether a particular company is worth investing. CYIENT's price was quoting at 1.1 times its sales. That is, the market cap was very near to where the sales or revenue was generated by the company. ECLERX market cap was 1.5 times away from the sales. So here we want it to be as low as possible so that we are buying at a good valuations. Next, let us look at how the profit has grown over 5 years compounded, and how the profit has grown over the last 3 years. So whatever the growth rate in profit was from 5 years, if the profit in the recent 3 years increases from that growth rate, then that shows a good value that the company's management is doing something to increase or speed up the growth in its profit. NIIT Technology's 5 years growth rate in profit was 6.1%, but in the recent 3 years, the profit seems to have jumped up at a faster rate of 22.5%. This is a good value to look at. Quess Corp's last 5 years profit was growing at 71%. In the recent 3 years, there seems to be some moderation in the growth rate in profit to 48.8%. Now, whenever we see such high values, we need to look at the base year's profit figure so that we understand whether the base year profit value was low, and if it was low, then of course we will see such high growth rates. But then in normal companies we don't see such high growth rates. So this needs to be investigated. CYIENT's profit growth rate for both 5 and 3 years was at a reasonable pace of 12.6 and 13.4. ECLERX profits were growing at 9.8 and 6.1, the lowest in the group company. Here, my criteria for the growth rate in profit for both 5 and 3 years is somewhere around 10% and more. Next, let us look at the price earnings to profit growth rate of the last 5 years. This PEG ratio helps us understand whatever price earning we paid for the company, is that justified? This is compared with the profit growth of 5 years, and then we understand whether the price we paid for the earnings, how fast that earnings are growing over the last 5 years. NIIT Technologies price earning multiple that we paid in the recent 12 trailing months or the recent year was 19.2 times, and we are getting a growth rate in that earnings of 6.1%. So when we divide the price earning with the profit growth rate, we get a PEG of 3.2, which is high. My PEG ratio for 5 years and 3 years should be below 1.5 at least. Anything about 1.5 means that either we are paying a very high price earning or we are not getting a high growth in profit. Quess Corp's latest price earning multiple was 25 times, but we are getting a high growth rate of 17.8% over the last 5 years, which means the PEG has fallen below 1, which is 0.4 for Quess Corp. So this is, again, as I said earlier, this is a very high growth rate, so needs to be investigated. CYIENT's price earning multiple was 10.6 times and the profit growth was 12.6%. Therefore the PEG is 0.9, which is again very good. Same is the case for ECLERX, where the price paid for the earnings was 9.5 times and that earnings was growing at 9.8%. So we get a PEG of 1 for the last 5 years. Or 5 years is basically for the growth in profit rate. Next, we'll understand how the PEG has come about for the profit growth of 3 years. Here we are trying to understand the price earning multiple we paid and what was the profit growth rate in that earnings over the 3 years. So we paid 19.2 times for NIIT Technology and we are getting a growth rate of 22%, so which is 0.9 for NIIT Technology. Quess Corp's PG was 0.5, which is again good. CYIENT's PG was 0.8, and ECLERX was a little expensive in the recent 3 years profit growth rate. It was at 1.6, slightly above my benchmark of 1.5. We are paying 9.5 times, and we are just getting a growth rate of 6.1%. So even though the price earning wise this is the lowest at 9.5 times, but there is no growth in that earnings. Growth is just 6.1%. Whereas even though for Quess Corp and NIIT Technology we are paying 19 times, we are getting a very high growth rate of 22% and 48.8%, which then brings our PG to 0.9 and 0.5. So as I said earlier, ECLERX 9.5 times is also very high. It needs to fall further, or the profit over the last 3 years has to grow so that the PG falls below 1.5 times or 1.5. Next, let us look at the growth in sales over 5 and 3 years period. Sales is a very critical part of the analysis because this is from where the actual revenue is generated and the profit, net profit, finally depends on how much sales the company has done. Sales also indicates the efficiency with which the management is conducting the business. It also shows the demand for the company's products, whether it is growing or it is reducing. NIIT Technologies revenue generation for both 5 years and the last 3 years was somewhere around 8%. So it has been constantly growing its sales over a period of 5 and 3 years at the rate of 8.2 and 8%. Sales growth rate for Quess Corp was very high from last 5 years at the rate of 53%, and in the recent 3 years the sales has moderated down to 35.4%. This again needs to be investigated as to why this company is growing its sales at such high pace, where the other companies are at a reasonable range of less than 15%. CYIENT's sales have been growing at the rate of 15.9% over the last 5 years, and in the recent 3 years it has slowed down to 14.3%. Same is the case for ECLERX. In the last 5 years the sales were growing at 15.6%, but in the recent 3 years it has slowed down to 13.2%. For me, growth in sales should be slightly above 10% at least year on year for both 5 and 3 years growth rates. Now let us look at the profit that the company has generated on the shareholders' money. First we'll look at what was the average of last 5 years and what was the recent RoE, and then compare that with each other. Last 5 years RoE percentage for NIIT Technology was 16.2. Even in the recent year it is exactly around its 5 years average, which is a good sign. Here for me my benchmark is 15% return on equity for both 5 years average as well as the recent RoE. Quess Corp's return on equity for 5 years was 14.6, but in the recent year of 2019 the return on equity has fallen to 10.3%. That is, the profit that the company has generated on shareholders' money has fallen to 10.3%. CYIENT has managed to increase its recent RoE above its 5 years average by 19.6%, whereas 5 years average was 19%. ECLERX RoE of the 5 years was 32.5% on average, whereas recent RoE has fallen to 22%. So this is the highest company which is generating profits on the shareholders' money. Here we have to understand what is the return, that is the profit. In this case, the profit is the net profit, and the equity portion is the equity plus the reserves that the company has. Here we are comparing return on capital employed of the last 5 years average with the recent return generated on the capital employed. Here we have to understand two things: what is the return and what is the capital employed into the business. So as return, we are using the value of EBIT, earnings before interest and tax, and for the capital employed, we are taking up fixed assets of the company and adding working capital to it. So that gives us, and we use the average of that of this year as well as the previous year, and divide it by the EBIT. RoCE for NIIT Technology was 23.4%, and its recent RoCE was 23.6, slightly above its 5 years average, which is a good sign. Here too, I want it to be 15% or whatever is the average of the group companies. CYIENT's RoCE is above its average, and ECLERX RoCE of the recent year has fallen below its 5 years average. In this case, this is the value of 2018 falling below its 5 years average. Here too, we see the highest return on capital employed was generated by ECLERX. Whatever capital was employed into the business, in terms of fixed assets plus working capital, on that, the highest profit was generated by ECLERX. Next, let us look at the profit generated on assets employed into the business of the last 5 years on average. Now in this case, assets are the total assets of the business, everything included, and we deduct the current liabilities from that, and we compare that with the profit generated. NIIT's RoE of the 5 years was 14.6%. Here too, I want it to be as high as possible. There's no fixed benchmark for this, but as high as possible it should be. Quess Corp returned 11% on its assets. CYIENT returned 16%, and ECLERX generated 34%, the highest in the group. Now, if it has generated so much return on assets, why is its price falling so much? That needs to be investigated. Next, let us look at how these assets were turned over into sales. This is the last year or recent year's asset turnover. Here we are trying to understand the assets. In this case is the net worth plus borrowings. How many times over the net worth plus borrowings that were invested into the business got converted into sales. NIIT Technology has converted its assets 1.7 times over into sales. That is, sales was 1.7 times more than the assets employed into the business. Here we want it to be as high as possible, so that shows that the assets employed are generating high sales for the company. Quess Corp has generated the highest sales against the assets employed by 2.4%. CYIENT's sales were 1.6 times higher than the assets, and ECLERX was lowest at 1.1 times. Here too, as I mentioned, we want it to be as high as possible. Next, let us look at how much profit the company has shown over the 5 years period, and out of that profit, how much has got converted into cash. That is, whatever profit that the company has shown, how much cash the company has actually received against this profit. So we use that comparison to find out CFO to PAT percentage. NIIT's profit was 1197, whereas it generated a cash, or it received a cash inflow of 1618 through operations. That is 35% above its 5 years profit after tax value. So this is what we want to see, that the cash coming in is more than the profit that the company has shown. Quess Corp's profit was 853, whereas the cash coming in through operations was less than that, almost 57% less than the earnings shown by the company. So then again we need to ask a question, why is the cash coming in through operating activity so less than what the company showed as its profit? CYIENT's profit CFO, that is cash from operations, fell short by 11%. Out of the profit of 1937, it received a cash of 1726, which is a fall of 11%. ECLERX cash was slightly 1% above its earnings. So we want the CFO to PAT percentage to be positive and at least as high as possible. Next, we'll look at how much of this cash that the company has generated through operations over the period of 5 years, how much of that cash is still left over as free cash, which would then indicate how much was used up in buying of fixed assets. Because free cash flow is calculated by removing out investments in fixed assets from the cash flow from operations. NIIT cash coming in was 1618 CR, against which its free cash flow or cash still left over with the company was 960 CR, which can be used in the financing activity of the business. So there are 3 activities: operation activity, investing activity, and financing activity. So that is 41% of the cash that the company earned through operations was utilized in buying or investing in fixed assets, or basically in assets, whether tangible or intangible. Basically, since this is a software company, it would most probably be an intangible assets. Quess Corp's free cash flow was 112 against the cash earned of 368, meaning 70% of that was utilized in investing activity or buying of assets. CYIENT's free cash flow was 1205, wherein the cash coming in was 1726. That is 30% of that was utilized in purchase of assets. And for ECLERX, 14% was utilized in purchase of assets. Here I don't want the value or buying of fixed assets to exceed 50% of the cash that the companies have earned. This is the benchmark that I have set for myself. There's no set rule that companies can't utilize more than 50% of their cash from operations into buying of fixed assets or assets. But if the company utilizes around 50-60%, then 30% is left over for financing activities like paying dividend or doing buyback or paying off loans that the company has. But if the company invests very heavily into purchase of assets, then that basically means very less amount will be left over for other activities. So there has to be some kind of moderation in how the company is spending its cash. Next, we'll look at and compare the profit after tax of the latest year and see how much of that has got converted into cash. Previously we saw profit and cash comparison, but that was for the cumulative 5 years. Here we are looking at the latest profit conversion into cash. NIIT's 2018 profit was 281 CR, against which it received a cash of 382, which was 36% higher. So this is a good value. Quess Corp's 2019 profit was 267, cash coming in was just 202 CR, which was a 24% shortfall. So this is not good. CYIENT's profit was 481 and cash was 370. That is a 23% shortfall. Again, not good. ECLERX cash was more than its earnings of by 11%. So this is a good sign. So here we are trying to look at the cash coming in to be more than the earnings of the company. In this chart, I am trying to understand the current year's profit. Is it above its 5 years average profit after tax or below it? So if it is above its 5 years average, it means it is positive. There's a growth in the company's profit. NIIT's last 5 years average profit was 239 CR, whereas the latest profit was 410 CR. That is 2018's profit value. That was 71% above its 5 years average. So we want it to be as high as possible. Quess Corp's profit was also higher by 50% over its 5 years average. CYIENT also managed to increase its current year profit of 2019 at 26% above its 5 years average. Only ECLERX 2018's profit fell below its 5 years average by 22%. But the thing to understand here is ECLERX profit value is of 2018. As soon as we get the 2019 value, we'll need to compare it again and see whether it has managed to increase above its last 5 years average or it's still below its last 5 years average. In this graph, I'm trying to understand the growth in profit year on year. For Quess and CYIENT, it would be from 2018 to 2019, and for NIIT and ECLERX, it will be from 2017 to 2018 growth rate in profits. Green represents preceding year and orange represents the latest year or last year. NIIT's 2017 profit was 267 and 2018's profit was 281. That is a growth rate of 5%. Quess Corp saw a fall in its profit from 2018 to 2019 by 16%. CYIENT saw a growth in its profit by 18%, and ECLERX saw a fall from 2017 to 2018 of 23%. That is a YoY degrowth of 23%. So here we want to see a growth in profit year on year and as high as possible. My criteria would be 10% and above. In this graph, I'm looking at the growth in sales and profit quarter on quarter, but from 1 year to the previous year. The results for quarterly analysis YoY, that is year on year, is for NIIT Technologies. We have June quarter results up to date. So we are basically comparing June 2018 with June 2019 values. And for ECLERX, we are comparing March 2017 value, or rather March 2018 value with March 2019 value. for both sales and profits. NIIT YoY saw a growth in its sales of 17%, but saw a profit falling by 3%. Here we want to see a positive value for both sales as well as profit. Anything above 10% is always good. Quess Corp saw a growth in its sales YoY, that is from June to June, of 22%, but again saw a fall in its profit by 2%. CYIENT saw a growth in its sales of just 1%, but the profit grew by 10%. ECLERX, again sales went up by 1%, but the profit fell by 7%, the highest fall in the group company. In this graph, we are looking at the quarter-on-quarter sequential sales and profit growth rate. That is from March 2019 to June 2019 quarter for both these three companies. And for ECLERX, we are looking at December 2018 to March 2019 analysis. NIIT's quarter-on-quarter sales fell by 1.1%, but the profit fell by 17%. So it's not a good sign. Quess Corp's sales went up by 4%, but the profit fell by 29% sequentially. CYIENT saw both its sales and profit falling by 6% and 49%. Only ECLERX managed to grow its profits and sales by 2% and 52%. But we have to understand this is from December 2018 to March 2019. Next, let us look at the net worth of these companies. This is different from the market cap that the investors have given to these companies. Net worth is the actual value of the company against what the market participants think the company should be actually worth. Net worth is calculated by selling all assets, paying all liabilities, and whatever remains is the net worth. The highest net worth was for Quess Corp at 2007 26 CR, and other two companies, NIIT and CYIENT, also were slightly above 2000 CR. ECLERX is lower at 1381 CR. Contingent liability is that liability which is not shown in the balance sheet, and also these liabilities can arise in the future, so we have to take care that as a percentage of net worth it does not exceed 20%. As we can see, none of these companies' contingent liability is more than 5% of its net worth, so this is a good sign. In this chart, I am analyzing three ratios together. One is, first we'll try to understand what is the debt of the company against the equity contribution, and then we'll analyze the debt that the company has and how much profit it is generating and how far away the borrowing is, or how quickly can it pay off its borrowings using the profit. And then we'll look at the interest coverage, that is what interest it paid in the recent year and what was its earnings before interest and tax. So we'll understand whether the company is in comfortable position to pay off its finance cost. NIIT, Quess Corp, NIIT, CYIENT and ECLERX all had almost zero debt against the equity. That is, their borrowing was almost negligent. In fact, ECLERX and NIIT didn't have any borrowings. CYIENT had 0.1 times its equity of borrowings. That is very minor. Only Quess Corp had debt to equity ratio of 0.3. That is, the debt was 0.3 times its equity. Here we want it to be as low as possible, below 1 times. So that is that for all the companies. In terms of debt to profit, that is, what was the borrowings and what is the profit that the company has generated. Here, since there was no borrowings, the debt to profit is 0. For Quess Corp, the borrowings were 3.2 times more than the latest year's profit, that is 2019's profit. So if the company has to clear off all its borrowings, it will take, using the current year's profit, it will require at least 3.2 years to pay off those borrowings, because of which its coverage has fallen below 4 times. That is, its EBIT, or earnings before interest and tax, is 3.3 times more than its finance cost. Whatever it paid as interest, against that the earnings or EBIT was 3.3 times higher. Here, for me, the interest coverage has to be at least 4 times higher, which means automatically that the EBIT will be 4 times higher than the finance cost. All other companies, since had very low debt or zero debt, their coverage was very high at 87. That is, EBIT was 87 times higher than the finance cost. CYIENT's EBIT was 17 times higher. NIIT's was 55 times higher. Next, let us look at the promoter holdings and if the promoters have pledged any of their shares. Promoter holding should be as high as possible. That would indicate that the promoters have a high stake in the company's well-being and they would manage the company in such a way that it keeps growing, and that would benefit them as well as the shareholders. NIIT's promoter holding was 34%. Highest promoter holding was seen in Quess Corp and ECLERX at above 50%. CYIENT's promoters were holding 23%, the lowest in the group. None of the promoters have pledged any of their shares. We don't want the pledge if it is to exceed 20% of the net worth. When the promoters start pledging the shares, it means that they are mostly getting out of the business. Not necessarily, but we can consider it that way, that they have taken up loan or borrowed money against those shares, and if they don't clear off that pledge, then most probably the banks or the institutions with which they have pledged these shares, they would sell it off in the open market, which would then basically there would be a huge fall in the price if there is sudden supply of shares from these institutions. Next, we are going to look at the debtors against these sales. Then how fast the company is collecting payment from these debtors, and what was the collection period 3 years back. Here in debtors to sales ratio, we are trying to understand how much payment was still to be collected from the customers as of 2018 for NIIT against the sales that the company has generated in 2018. Then that would indicate to us whether the company is collecting or giving or collecting the payment faster from the customers, or whether it is lax in collecting the payment from customers. Here I don't want the collection to be done to exceed 30% of the latest year's sales. NIIT's debtors were 15.4% of its latest year's sales, and all of these companies have managed to keep it below 20% of its sales, so which is a good sign. NIIT is collecting payment in the recent year from its customers within 71 days. But 3 years back it was taking 93 days, highest in the group companies. So basically it has improved from where it was 3 years back. It is collecting payment faster within 71 days. Quess Corp's collection from debtors was less at 10%. Not only that, but it was also collecting at the fastest days of 39 and 43 days. In fact, it has improved further to 39 days in the recent year of 2019. CYIENT's collection period was 64 and 72 days, and the debtors were just 17.6% of its sales. ECLERX was also very similar to CYIENT. Next, let us look at the average operating profit margin of the last 5 years for these companies, and then also compare it with the latest net profit margin and the net profit margin of the preceding year. NIIT 5-year operating profit margin was 16.3%. I want the OPM to be at least above 15% as my benchmark, which would then suggest that the expenses that needs to be deducted from this OPM or operating profit margin, like interest expense, depreciation, tax, so on, that would reduce it further down to 10% of net profit margin. So if the company is not generating 15%, that is basically some kind of weakness. So we need to understand where the problem is. Why is the company not able to generate 15%? Although the company's 5 years OPM was 16.3, its net profit margin was below 10%. So these companies don't have, this particular company, NIIT, does not have a margin on its revenue. The latest year's NPM was 9.4%, slightly above its previous year of NPM of 8.9%. Here we are comparing 2018 with 2017. For Quess Corp, the OPM was very low at 5.4%, and the NPM was even lower at 3% for the latest year of 2019 and 5% for 2018. So this company is generating very less margin on its revenues. CYIENT's OPM of 5 years was 13.6%, and it did manage, although the OPM was less than 15%, its NPM was still above 10% for both the recent year as well as preceding year of 2018 and 2019. ECLERX OPM of the last 5 years on average was 34.2%, highest in the group. Now we have to understand why this company is generating so much OPM, and even the NPM is above 20%. So the company is doing something good that it's generating such high operating profit margin as well as net profit margin. Its latest NPM was 21%, and the 2017's net profit margin was 26.6%. We'll need to look at what is the NPM of 2019, because the value here is only up till 2018. Next, let us look at the current ratio and quick ratio. This is the liquidity ratio, which measures whether the company can pay off the current year's liability, that is those liabilities which have to be paid within this year, against the assets that the company owns and which can be sold within the current year. So we are trying to understand whether the company is liquid enough to pay off its current liabilities using the current assets. So all of these companies are very easily able to pay off their current liabilities with their current assets. We want the ratio to be more than 1 times, which signifies that the company has enough current assets and the liabilities can be taken care of using those assets. The highest ratio was for ECLERX at 7.9 times. Their liabilities were very less and their assets were very high. Next, let us look at what was the total assets that the companies owned at the acquisition cost and how much of that has been depreciated over the number of years since they bought those assets. Since these assets have not been written off completely, they are still there in the company's books. And here what we are trying to understand is what was the total assets that the company has with it, and of that how much has already been written off to the P&L account, and how much after removing out the accumulated depreciation, how much is left over to be depreciated over the future years. NIIT's assets were 1254 CR. Out of that, 375 has already been depreciated, which basically amounts to around 30%. So 70% of it still needs to be depreciated over the future years. Basically, why I am looking at this graph is to understand what is the expense that will be taken to the P&L in the future coming years based on the asset that the company has. Many of these companies' depreciation expenses may be high against the profit or operating profit that the company generates. Here I want the accumulated depreciation to be as high as possible, which then would indicate that most of the assets that the company has already been expensed out via depreciation to the P&L account. Quess Corp's accumulated depreciation percentage is very less at 18%. Out of these assets of 2000 CR, only 364 has been depreciated, and the balance 1700 or so still needs to be depreciated over the future years. So the expense will keep occurring for this company over the future years. CYIENT's gross block has already been depreciated by 47%, highest in the group company. So the balance still needs to be depreciated over the future years. ECLERX depreciation percentage is also 30%, so which is good sign. So 70% is left over. So I want it to be as high as possible. Next, let us look at the net block, and this is the assets after removing out accumulated depreciation from the gross block. That is, again, as I explained, gross block is the total assets at its acquisition cost. Out of that, whatever depreciation has been taken out till date, after that whatever remains is the net block or net fixed assets. And what is the depreciation charged on it? What is the percentage rate on it? That needs to be understood. NIIT's net assets after all the depreciation, accumulated depreciation, in the recent year of 2018, 127 CR was deducted out of this and expensed out to P&L account. So that was a 16% of depreciation rate. Here, if the depreciation rate is very high, then that will reduce the profits of the company, and if it is very less, then it will inflate the profit of the company. So we need to look at a balanced depreciation rate in these companies. If any of these companies are charging very high depreciation rate or charging very low depreciation rate, then that is basically a red flag or a problem of or a sign of a problem in the company. Quess Corp's depreciation rate was 7%, so it is depreciating its assets at a very low rate. So basically that would again inflate the profit. As we saw earlier, its profit margin is already very less at around 5% or so. So here they are reducing at a very low rate. So the assets that the company still owns is 1600 CR. On that, only 123 CR was depreciated in the 2019 year. CYIENT's depreciation rate was 11%. That is on assets of 978, 111 crores were transferred to P&L account in 2019. ECLERX is depreciating its assets at the rate of 14%. So this concludes my analysis for this particular graph based analysis. Now I'll just put in the ranking for all of these companies and color code them, and then we'll try to understand for all of these ratios which company has performed the best. To continue with the analysis of these companies, I've ranked them according to the ratios which have scored the highest would get 4 points. The ones with the lowest score would get 1 point. This is a very simple way of marking. This is a system where I can understand which companies have got the highest score in all the ratios. None of these ratios are given any particular importance or higher ranking. All are ranked equally. NIIT's, Quess Corp and ECLERX all had their face value at 10 except for CYIENT at 5. So given it 3 points and 4 points for all of the rest of them. NIIT Technologies stock had fallen the least at 10.6% from its 52 weeks high. CYIENT had fallen 42%, but since the other two companies had fallen more than CYIENT, therefore it got ranked third. In terms of earnings yield and price earnings, since they are both opposite of each other, they would all get the same type of ranking. So ECLERX as well as CYIENT have done the best price earning and earnings yield of 9.2% in earnings yield and 10.6% in price earning, and 10.3% in earnings yield for ECLERX and 9.5% or 9.5 times in price to earnings ratio. In terms of last 5 years and 3 years average price earning, CYIENT has done the best at that. It was available at 15 times its earnings. ECLERX in the recent 3 years was available at 17 times, and NIIT Technology in the recent 5 years, the price was 15 times more than its earnings. Price to operating cash flow was best for CYIENT and ECLERX. Price to free cash flow was good for CYIENT and ECLERX again. Even price to book value was lowest for CYIENT and ECLERX. In terms of price to sales, Quess and CYIENT were available at the lowest multiples. Profit growth rate was highest for 5 years for Quess Corp at 71 and CYIENT at 12%. Profit was growing highest in the last 3 years was for NIIT and Quess Corp. PEGs were good for Quess Corp and CYIENT for both 5 and 3 years. Sales growth for both 5 and 3 years was highest for Quess Corp and CYIENT. RoE for the 5 years average was good for CYIENT and ECLERX. The recent RoE was again good for CYIENT and ECLERX. RoE growth rate was seen highest. The highest growth rate in RoE was for CYIENT at 1.4% from where it was 5 years back. Although NIIT Technologies RoE has fallen at 4.9%, it has fallen less than the other two companies. RoCE growth rate for 5 years was seen highest for NIIT and ECLERX, and the recent RoCE was for CYIENT and ECLERX at 23 and 28%. In terms of return on assets over the 5 years period, CYIENT and ECLERX have done the best, generating the highest profit on its assets employed. In terms of turning over the assets into sales, NIIT and Quess Corp has done the best. ROIC or return on invested capital was the best for NIIT and ECLERX. In terms of cash conversion of the profit, NIIT has converted the maximum along with ECLERX, and the other two companies cash fell in short by 56 and 10% below its profits of 5 years. In terms of free cash flow, The maximum free cash flow was seen for CYIENT and ECLERX, and Quess Corp and NIIT used up most of their Quess Corp used 69% in buying of fixed assets, and NIIT Technologies used in fixed assets was 40%. In terms of growth of profit above its 5 years average, the best growth was seen for NIIT and Quess Corp. In terms of year-on-year growth rate, NIIT and CYIENT have done the best. In terms of annual cash conversion of the profit, highest cash conversion was NIIT and ECLERX. In terms of profit and sales growth rate, YoY, NIIT saw a growth rate in sales of 16% and Quess saw a growth in sales of 21%. The other two companies had a low sales growth year on year, and the profit growth rate from year on year period was seen best for Quess Corp. Although its profit fell by 1.6%, it fell less than the other two companies. CYIENT's profit increased year on year by 9.7%, and although its sales grew by just 0.8%, the profit went up by 9.7%. In terms of net worth, the highest net worth was for Quess and CYIENT. These are big companies in the group. Next is the contingent liability. Highest contingent liability was seen for NIIT and Quess Corp. The other two companies had low contingent liability. In terms of highest debt was for Quess Corp at 0.3 times its equity. Therefore, its interest coverage was also very low. The interest coverage fell below 4 times, and the borrowings were 3.2 times higher than its profits. The other three companies have done well because their debts were very less. The promoter holding was seen highest for both Quess Corp and ECLERX. NIIT and CYIENT's promoter holding is low at 33% and 22%. None of these companies have pledged their shares. The highest debtors was seen for CYIENT and ECLERX against their sales. The debtor days or fastest collection days was from Quess Corp and ECLERX collecting. In fact, Quess Corp was collecting in less than 50 days and ECLERX was collecting in less than 60 days. In terms of net profit margin and the 5 years operating profit margin as well as the previous year's margin of net profit, highest profit was seen for ECLERX in terms of OPM as well as NPMs. Even the current ratio was very good for ECLERX at 7.9 times its liability. CYIENT has also done well. Its 5 years OPM was 13.6% and NPMs were slightly above 10%. Even current ratio was good at 3.3 times its current liability. In terms of how much of the gross block has already been depreciated, the highest depreciation was seen for CYIENT along with NIIT, and the lowest was Quess Corp. Most of its assets had seen a minimal depreciation, and in terms of what is the depreciation rate charged on the net block, highest depreciation rate was NIIT and ECLERX depreciating their assets at 15.6 and 13.9% each. The highest dividend yield was seen for CYIENT and NIIT Technology. CYIENT was giving a dividend yield based on the current price at 3.2%. I'm going fast in analyzing these ratios because I have already analyzed these ratios in graphs. Let us combine these separate ratios and group them into different metrics. I have 6 metrics. Efficiency, in that I'm considering asset turnover, how well the assets have been turned over into sales. What is the contingent liability against the net worth? What is the debt against the equity? What is the EBIT against what it paid, what the companies are paying as finance cost? What is the debt or how much is the borrowing against the profit of this year? How much is the debtors or payment still to be collected against the sales of this year? How fast is the company collecting payment from the customers now and 3 years back as well? How well the company is turning over its inventory into sales? What is the total accumulated depreciation on the gross block? And what is the depreciation rate that the companies are charging on the net block? I've considered these ratios under the efficiency metric. In terms of solvency metric, I'm looking at promoter shareholding. Have the promoters pledged any of their shares? The current and the quick ratio. In terms of cash flow metric, I'm using CFO, that is cash from operations, and comparing it against the profit after tax for the 5 years, and how much of the cash that the company has earned has been left over as free cash in the last 5 years, cumulative, and what is the latest conversion of cash or conversion of profit into cash. In terms of growth metric, I'm comparing sales growth of both 5 and 3 years, profit growth of both 5 and 3 years, growth in RoE from last 5 years, how the profit has grown above its 5 years average, how is the profit grown from its previous year, what is the growth in sales quarter on quarter as well as year on year, profit growth rate quarter on quarter as well as year on year, as well as how big the company is in terms of net worth. In return metrics, I'm considering earnings yield. What is the profit that the company is generating on the current price? Return on equity of the last 5 years on average. What is the profit generated on equity in the latest year? How much profit has been generated on capital employed in the last 5 years? What is the profits that the company has generated on its assets over the 5 years? How much profit has been generated on invested capital? What is the operating profit margin, net profit margins, and how much is the dividend that the shareholders are receiving? Finally, in the valuation metric, I am considering the latest price earning of 5 and 3 years, the price to operating cash flow, price compared with free cash flow, price compared with the book value, and price compared with the sales. And I'm also considering the price earnings to growth or PEG ratio of both 5 and 3 years under the valuation metric. Finally, to conclude, in terms of efficiency, ECLERX and NIIT both have scored highest points. In fact, Quess also added 22 points. But since the overall ratio or overall individual numbers was better for NIIT, I have given NIIT ranked 3. In terms of solvency, again ECLERX as well as Quess Corp have got the highest points of 11 and 9 points. Cash flow metrics was very good for both ECLERX and NIIT Technologies. In terms of growth metrics, that is how it was growing its sales and profit, Quess had the highest growth in profit and sales, and it got highest points of 40. CYIENT also managed to grow its sales and profit at the highest pace and has got 31 points. In terms of profitability ratios or return ratios, highest profitability ratio was seen for ECLERX and CYIENT at 42 and 31 points. In terms of valuation, the best script which was available at the lowest valuation was ECLERX and CYIENT, and they got the highest points at 31 and 28. These are the most reasonably valued as of today based on different metrics. To conclude this analysis, ECLERX has got the highest points of 146, CYIENT has got 133, NIIT has got 122, and Quess has got 110. So out of these companies, ECLERX seems to be the best of the lot. Thank you for watching this video.